Hi, Ben Kingsley here, Managing Director of Empower Wealth, and I'm with Michael Savy, who's a partner in our advisory practice and heads up our financial planning team. If this is the first time you've watched an update from us too, you would have missed an original update that we did back in the March pre-COVID, as COVID was just coming out. Now we thought we'd do another important update for you and look at a bit of the data out in the marketplace to just set the scene, because we are coming out of a post-COVID period and there are a few clouds forming in regards to the broader global economy and also what's happening on the share market. So Michael, thanks for your time today.
Not a problem, Ben.
What I thought we'd start with is just, we did an analogy or a story around what was happening during that COVID period. So let's use that as a starting point in terms of where we saw the marketplace at that time.
At the time, this big uncertainty, a health issue. We were going into lockdown, well, potentially going into lockdowns. We didn't quite know what it was like. So I used, to try and simplify the scenario and explain it to a lot of our clients. I used a car analogy where, we were looking to go on holidays, but we couldn't because of lockdown, et cetera, et cetera.
Cars in the garage.
And, the Federal Reserve and the RBA, I complimented them on how great a job they did for keeping the car ready to go and keeping us from a recession. So I thought it'd be apt to use the similar car analogy just to try and walk and explain to our clients, as simple as I can, some of the issues that are facing the Federal Reserve and how that then subsequently impacts us and even our individual households as well. So in this case, let's say we're going to use this car analogy. Now the difference here is that the driver on this occasion, in this instance, is not us, it's the Reserve Bank Governor, Philip Lowe, and the Fed Reserve. Now, essentially, they're in the car and they need to get to the airport because they've got a flight booked, and we all know that feeling. And here in Melbourne, we're on the Tullamarine heading towards the airport, but then we come to this sudden break where we need to stop because there's an accident. And all of a sudden, we're trickling through slowly past the accident, and then we realise that we've just lost some time, and we know we've got to get there so we can put our bags and whatnot. So what do we, naturally, most people, what would they do? They'd floor it, and more than likely we're going a little bit above the speed limit. Essentially, that was the COVID.
We come out the other side.
We had this slow lockdown. We tried to get out of it by putting stimulus.
Heaps of fuel in the tank.
Exactly.
Plenty of cash in the household.
Exactly. And now we're accelerating to try and make that flight. But the problem is we're well above speed limit. Our ultimate goal, or the RBA's ultimate goal, i.e. the flight, is to get to within a 2 to 3% interest rate range. So they are mindful of that, and they are mindful of the fact that they are speeding. Now the problem is that, and I'm going to steal and paraphrase from Ben Bernanke, the role of the government and the tools at their disposal. It's a bit like being behind the wheel, looking at the odometer or the dashboard, which is not working the best. So it's a bit sticky, so we don't quite know.
A lot of noise in it.
We can see that we're probably doing 100 and a bit, but we need to slow down. So then therefore we're going to have to step on the brakes a little bit. Now the problem with this car, with a bit like the tools available to the RBA, is that it's a bit sticky. So putting the foot on the brake, it takes a little bit of time for it to kick in. Similarly, when we accelerate, it takes a little bit of time to kick in. And that is the transmission mechanism of interest rates. It takes somewhere between 6, 12, 18 months to fully deploy. So that's the position that they're at. They know that they need to get to the airport so they can catch their flight. They know they're speeding, but they don't want to cop a speeding fine, but they've got these dodgy odometer and a couple of dodgy brakes and accelerator.
I think it's a wonderful analogy because effectively we're trying to get on top of inflation as soon as we possibly can. So that's that urgency. And like what you're saying around pumping the brakes, even though we're pumping them, we're not getting enough fluid in there, so it's not slowing the car down quick enough. So it's this sort of stop-start sort of situation that we've got. So I thought, okay, let's turn to some of the data that we wanted to talk to. The first one is obviously very much this inflation story. Now, unless you've been living under a rock, you would know that inflation originally occurred through Russia's invasion into Ukraine, as well as obviously all of the supply chain issues and bottlenecks that we saw during that stop-start COVID experiments and those types of things that were also happening as well. So we've now starting to see, some really good examples of shipping costs coming down, some of those bottlenecks starting to, so that supply side inflation story, whilst we still have Russia and Ukraine and energy costs and all that, is very, very high, we're starting to see that sort of now come off a little bit, but we've now got a little bit of demand-led inflation that's in there, and that comes back to we're all cashed up.
Yeah, look, and absolutely. So, I mean, all else being equal, the more money we dump into the system, as what the government did during the COVID, which was the bit that I was complimenting them on previously, the more money we have in the system, the more that we can bid for assets, and that's where we get the inflation. Now, this is one of those strange periods in time, a confluence of a number of different factors have come through. So we have the demand side, more money in the system, we have geopolitical factors, and we have different COVID policies around the world which has caused supply chain disruptions. And so they've all come together. The hard part for the RBA is to work out what is the systemic general inflation, what is this the inflation that's come through because of those one-off factors, or so for example the Ukraine situation. So we all knew that inflation was going to kick in at some point. Now, what we've noticed is that, or the data presenting is that, especially in the US, which we get to see a little bit of a gauge, because here in Australia, we were in lockdown when they were still opening up. We can sort of see the trajectory of where we're going to head towards, which is similar to theirs, maybe not quite as high. But absolutely the inflation's gone up quite significantly, the highest in quite some time, in decades. And so the RBA and the Federal Reserve needs to rein that in.
Yeah, well, let's have a look at so there's the headline US inflation number that we saw, and then we also are seeing the Australian headline inflation. So we're definitely lagging the US and the UK, and we are definitely seeing a synchronised attempt by all of the Fed reserves around, and the reserve banks around the world, in the Western developed world, they're starting to raise those interest rates because everyone's trying to bring that inflation genie and bring it back into the bottle. And so through that mechanism, in terms of, the conflicting data points and an understanding of where that's going to land, it's very hard to determine because we still have a lot of pent-up demand and we still have obviously cash in bank. So it's just how far the reserve is going to have to go.
And the reason why I've got a point there with regards to, when there was a slowdown, even in the GFC, everything slowed down. We avoided a recession. Other countries went into the recession. Even for us here in Australia, we had to increase, with all the stimulus money that we had going into the system, the RBA did have to increase rates from about 3% up to around about 4.75 because of all the stimulus money to sort of, again, slow down, keep the inflation in rein. And now that, as difficult and as bad as the GFC was, it's not as confusing as what we've got now because, again, we have these conflicting data points where, for example, property prices are going down in certain areas. Usually that's accompanied with unemployment. An increase in unemployment, but yet here we've got low unemployment,
record low unemployment,
exactly.
50-year
the property prices coming down.
It's a perfect segue, Michael, into obviously the next chart that we wanted to show, and we can definitely see that when inflation comes into the markets, what's generally speaking what happens is that the investors are looking at those businesses that make up the equity markets, and they're sort of saying if inflation's coming in and the reserve banks and governors are trying to slow down the economy, so it's a manufactured slowdown, then everyone's worried about earnings, everyone's worried about profitability, and we see an adjustment when it comes to the asset prices and the valuations of those businesses. And you were referring to this example, so talk us through this example.
So what I've got here, one of the benefits of working at Empower Wealth is that we have a lot of clients who have investment property portfolios, and intuitively, Australians being lovers of property, we know that when the RBA increases interest rates, property prices generally will come down.
Generally speaking,
generally speaking. Now, the same thing also happens in the stock market world. The difference here is that we're probably more reliant on the 10-year bond rate as our, that's the preferred data point that we use as opposed to the RBA. That's not that we ignore the RBA rate. In fact, that's where we look at the yield curve, essentially. But what I wanted to highlight there was that the relationship between interest rates and the investment markets are pretty strong. So you can see there I've just put in the US 10-year rate and the three different markets, the ASX 200, the S&P 500 in the US, which is a broad-based index, and then the NASDAQ, which a lot of people are familiar with. They have the high growth high growth tech stocks and things like that. Now, if you look at that chart, if you flip that 10-year rate upside down, you'll notice that the stock market actually operates and moves very similarly. But on top of that, different markets and different types of stocks get hit differently equally, in that when the interest rates went up, high PE stocks, and that can include CSL and those types as well, they will get hit more than, let's say, if you've got a big blue chip with high profits, high income, which is why in the news you'll probably see, or if you're reading the financial papers in the Herald, they are talking about, look, if you want a defensive portfolio, you would be looking for companies that have strong income. It's protection against the inflation or the interest rate expenses. But on the flip side, some of the smaller companies, which we can see here that have come off, they are also the ones that have the capacity to increase earnings over time. It's just that they don't have earnings now, or profits now, I should say.
You're seeing those, you're seeing the top indices such as the ASX 200, the S&P 500 and the NASDAQ. There is obviously going to be opportunities in the marketplace for the individual businesses, and that's part of the work you do in terms of trying to find those individual businesses. But I just wanted to remind, if we look back at the chart again, you can see that inverse relationship. So when you're sort of looking at the July period, so June-July period, you can see that the bond yield is coming down, but there's actually the equity markets are rising. And then you can see when the equity markets are coming up, the bond market's coming up, you can see the equity markets coming off. And that's that inverse relationship that we're saying. There's a flight out of those markets into the bond market.
Look, and I remember hearing many years ago, the doing business or running a business pretty basic. Buy something for $1, sell it for $3. These companies are faced with the same thing. Money, or borrowing money, or the cost of money, is one of those expenses in our line item. So if we're buying, where we used to be buying it, a 30-year bond at 1%, but now I'm buying it at 3%. There's only a few factors where, if you have a strong enough business, you can pass on that cost. But if you can't pass on that cost, you as a business will have to absorb it. So that impacts some of the profits looking forward, and that's what the market's trying to predict.
And they're obviously saying all of those businesses with potentially high exposures of debt, you're going to be paying more for that debt because inflation's going up, and obviously that's forcing up the interest rate, so you're going to be paying more for those. On the bank bill, swap rates is going up, so cost of money is going up, and that's a manufactured slowdown to try and get those businesses to not continue to lift inflation. That's where we don't want that inflation to be ingrained in the psychology of each economy, including the Australian economy as part of that. So I think that's probably a really good segue into looking at the noise in the data, because I want to make sure we come back and talk about what are some of the things we need to be looking at when we're thinking about the equity markets from a PE point of view and earnings versus those types of things. So we'll come back for that. But let's have a look at this, what we're seeing now. We've definitely, you can see here, obviously, why we're having this conversation with you again is because back in March of 2020, when COVID first hit, there was a lot of uncertainty, and you can see consumer sentiment completely collapsing, very similar to the way in which it did during the GFC. And we're now down at a very similar level. It didn't quite get to as low as that, and we're now on the improve. But anytime there's uncertainty, and again, the reason why we wanted to sort of produce this update is because with uncertainty becomes, lack of confidence. And so we know that when the RBA slows down their cash rate movements and the marketplace, takes a breath, I suspect that sentiment will start to shift up. But on the other side there, just take us through the household income and consumption story there. Michael.
Yeah, look, as per the title or the main line there is a lot of noise. If you look through because we track the data points on a month-by-month basis, the drop in sentiment also coincides with the noise picking up. There was front page news. I always tell a lot of my clients the only time you see financial news on the front page of the Herald Sun is when there's a crisis.
When they're losing money, and when there's a quick correction.
So, and once we started seeing that, the sentiment started coming off, we all anticipated that, yes, it will have to increase at some point, but the sentiment dropping so significantly. Now, as you said, the sentiments dropped similar to the GFC. But again, the thing that I would flag to our clients, and what I hope to get the message to a lot of our clients and those listening are, when we have a lot of noise, it's always important to refocus on what we can focus on. And you can see there in the savings ratio that we've got there, unlike during the GFC, because we were forced to save, our savings rate went through the roof.
We couldn't spend the money.
Because we couldn't spend the money.
But the car was locked in the garage.
Exactly. Over the last year or so, depending on which state you're in, we've been able to go out and spend some of that money, but we're still naturally holding on to a slightly higher savings rates. Now, you'll see some data points, and this is what I mean by conflicting data. Some people will say that, average savings rates around about 8 to 9%. But I look at it probably a shorter time frame in my working career. The savings rate was probably more, from what I've seen, was around about 4 to 5%. I mean, at the start of my career, I remember we were in a dis-savings rate where everyone, the TV ads on Equity Mate, people were releasing equity.
And in terms of debt to income ratios and so forth, they haven't exploded. But the reality is also that we are taking on bigger debts because the value of assets are worth more in the future.
So the key takeaway from the savings ratio, but also from the perspective that we saved, we've got more money in the offset, we've paid down some of our debts, and our interest rates that we're paying now are still relatively cheaper than what it was, let's say, in 2010, 11. So the household balance sheet's actually a little stronger than what it was probably going in pre-COVID.
And combine that with the unemployment story. Now, we would expect the unemployment story to trickle up over the next...
It needs to trickle up in order for the RBA to get to catch their flight. They need the unemployment rate to go back up. Certainly not to the 7s or 8s that we saw, but I mean, getting to a natural rate of somewhere between the 4 and 5%. And that was one of the mysterious things over the last 10 years, pre-COVID. There was all this money going to the system, but wage inflation wasn't going up, and inflation wasn't going up because there was a bit of slack in the employment, and it wasn't until unemployment dropped below 4 before we started seeing that.
That's true. So let's look at this next slide here. We're also talking about, there's obviously a couple of key messages that we want. Now, I did say I promised to circle back around the opportunities that you might see in the market, because I'll start off by just sharing a story. Michael was right in the sense that, the noise that we hear in the media and in terms of what's happening, especially on those big correction days, the market lost $60 billion or blah, 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 blah. If you're in a situation where your circumstances aren't any different, then there's nothing to see here. I mean, just look at the share price accumulation indices there. You can see that long-term trend. We did see, obviously, the correction that we saw during the GFC in there as well. And we're now seeing, where that trend is going. So I use the great Benjamin Graham quote, which is around that in the short term, when we are hearing all this noise, it's only natural to feel a little bit uneasy, uncertain about that type of thing, because that's what's happening. Now, Benjamin Graham used to say that the share market in the short term was a voting machine, but in the long term, it was a weighing machine. And what you're seeing there in those longer term sort of, several decades that we're looking at there, or 2 decades that we're looking at, is you can see that's the weighing machine. So if your situation is currently where it's at, it really is about sticking to your plan. And coming back to your point, we're obviously looking at indices there, where do you focus in on finding that value that we were talking about in those individual companies?
Look, I guess no different. I mean, if you've read Ben Graham or listened to the Warren Buffetts and so on and so forth, I mean, in a period of high inflation, if it was prolonged, one of the best ways, and I use the analogy, and I think Warren Buffett quoted it, something along those lines as well. If we knew that inflation was persistently high, so if you're a wage earner, how do we go about beating inflation? Increase our salary. So how do we beat that? We would study, do some education, do some training. Similar for companies, what we're looking for are those, if we're in an environment of prolonged inflation, then those that can generate good earnings growth over the long term. You can certainly buy some companies in the value space as well at the moment, which will give you the immediate protection. But that's what we're always looking to manage between the short term and the long term as well for our clients and in the portfolios. But I guess one of the reasons why I've put these two charts together is that is really marrying the long term with the short term. So the short term elements of, let's look through our household information. And as I said, there's a lot of conflicting data. So people like myself, again, we get emails and reports of data. And it's our job to go through and have a look at it. And even for me, it can be a little bit confusing and overwhelming.
There's a lot of question marks. There's a lot of uncertainty at the moment.
And that's why even for myself, I return to first principles. What am I looking for? What is the data set? Block out some of that noise so you can focus what we're trying to achieve for our clients and look at those inputs. Similar thing can happen for clients. So ignore the noise to some degree. Look at your household. Look at what debt levels you've got. Is it really going to impact your long-term objective? And I guess that's where I may circle back to, in the scenario of using the car example where we had earlier with the RBA driving.
Yeah.
But let's bring it back to the same scenario. We've got to get to the airport because we've got a flight to catch. But on this occasion, it's you driving, you and your family. Now, the objective there, the flight on this occasion, is your retirement or whatever goal that you've set.
Yep.
Now, if we have the same issues, and you're going to face plenty of these issues, this is not going to be the last one.
No.
And if it's your first one, hopefully.
Yeah.
But if you're on the road and you face those types of turmoil, a bit to what you're saying with regards to markets, even if you have the dodgy dashboard and the brakes, you might want to just slow and be more cautious. But if you're going to pull over because you're afraid of it, I can guarantee you one thing: you're not going to make the flight.
No.
You're not going to make your retirement objectives or whatever goal it is. So it's being sensible, cautious, ignore the noise, ignore the noise.
And which is the news.
Yes. Ignore the noise and just focus on what is your objective, what is the place that you're in at the moment. When you marry that with the longer term elements of this, you can see the market will do what it needs to do. And that's why I put these two together. And a lot of this is sentiment driven as well. So I've got in there, are we at the capitulation phase?
Yeah.
It's one of those things where when the markets are going up, everything's great. We will overpay and we want to pay more for certain assets, even though we don't want to. On the flip side of things, when things are a bit like what we're at now, a lot of noise, a lot of concern, that same asset doesn't look as attractive. But again, the job that we do the look through.
Yeah.
You might find a company that's still growing in earnings, expanding their market and footprint, still got growth targets for next year, but yet the share price has dropped by 50%. So the question is, what do we do?
And I think that's a really good reminder. I mean, as part of the work that you do and the team does is to look for those types of opportunities. I mean, earning per share, and as you say, PE ratios are definitely going down because asset values or the share prices are going down. But there are businesses out there that are bucking those trends. And during these cyclical stages, we've also got to remember, there's an aging population, so there's going to be health stocks that are also going to be, perform well. We also know when people put their hands in their pocket on discretionary spending and then start to look at the essential spending, those types of businesses are potentially going to go okay and they're delivering still a good yield return. So it is going to be a case-by-case basis for each household in terms of, for me, it's almost like, well, I've still got another 10 years to wait. So I'm not too fussed about where the market's at today. I'm not going to change many of my positions. I'm playing the long game as part of that particular story. But if you're unsure, there's a couple of things you can do. If you do have a plan, my recommendation is don't get distracted by the noise. Don't get distracted by what your friends and that are doing as well. Just talk to your professional advisor. Make sure if there is any concerns you have, reach out to them. But if you've recently done a review and your advisor's not reaching out to you, normally that's the case of we're going to play that long game as part of that story. We obviously are passionate about educating you, so I do an economic update once a month as part of the RBA announcement. I've been talking about Jerome Powell's commentary recently around he wants to get in front of inflation now because we all know that if it races on, it's going to be a harder landing. And so we're seeing again not only Jerome Powell but all the others
Look,
doing that.
And I guess for those who here at least we're lucky and we're in a first world country, developed world, and inflation at these levels. Some of my parents in their generation would have seen slightly higher inflation. To acknowledge why it's such an issue, I mean, the problem with rampant inflation, hopefully, fingers crossed, we never get to those positions. If you look at places like Zimbabwe at one point, or in Venezuela, where inflation got so rampant because of geopolitical situations where they're literally taking monetary notes and making hand baskets out of them.
Yes.
So that's the worst case scenario.
Well, and you've never seen that happen in a developed world.
That's right.
Like in a developed economy where, again, there's strong geopolitical, good governance systems, low corruption, those types of things. It rarely happens. It's usually a result of, sort of very, very difficult geopolitical situations in those countries. So I can't think of any demonstrations of that happening. So let's close this out. I mean, obviously there's a couple of really important points that we wanted to get to. Michael's analogy with the car is really important for you, and that is you're driving the car, you know what your destination is going to be in terms of your plan, your strategy, so maintain that strategy. You can see in some of the slides that we've put in front of you today that we do know that there's good savings, household buffer savings. You can see also in the debt to credit or income ratio, household credit to income ratios there. There's a lot of those savings when you look at offsets. So that is not necessarily out of control that some media outlets might claim that those types of things happen. And just stay calm. Reach out to your professional advisor. If you're working with one and you want to, assess your current situation, I wouldn't be putting any panic on. There's no need to basically, make any rash decisions in a market like we've got
Absolutely,
today.
because I mean, the clients that have worked with the property wealth plan and even within the financial plan, when we're doing these long-term modelings for clients and building their strategies, we usually build in buffers, 2.5%, 2% on interest rates, even though, 2 years ago you were paying 1.9.
Yeah.
We would certainly be putting on buffers and using long-term reversion to mean numbers.
Well, we know in the platform, in our more platform, that there's billions of dollars in cash, over $6 billion in cash last time I looked in terms of households. So that just gives you some indication. So as we round it out, just remember, if you want to continue to build your knowledge in this space, talk to your trusted advisor as part of that particular story. Listen to our economic updates. If the situation was to deteriorate further, you'll be hearing from us in terms of further updates. And it's okay to feel this unease, because it's not what you do all the time. We have obviously been through several of these cycles, so that's a natural feeling. It's just about how you then respond to that. And we're sort of saying, just remain calm, reach out if you need any professional help in regards to that, and basically go forward and conquer. I mean, this is all about lifestyle by design, creating that financial peace. What we see, the horror stories of people who have exited out of the marketplaces. In other words, they've pulled over the side of the road, they've got off, coming back to Warren Buffett's statement before about earning more income. If you're not earning more income or can't get a higher paying job, make sure your money's working harder for you. And if you're out of the game and you're sitting on the sidelines, you might be thinking you're protecting that money, but we do know over time that there has been strong evidence of the biggest performing days in the market will materially impact your overall return. So if you're not in the market, you're not going to get those upsides. Yes, you're also going to get some of those downsides, but you can see, referring back to the graph, the trend is your friend over the long term. Let that money do its magical compounding story. Pick those right companies, get those right investments. You don't have to be just invested in the overall indices. You can also, pick the eyes out of those particular types of businesses, and that's a boutique strategy, which is effective for some, may not be wise for others, but we'll just basically see how it plays out. So thank you again for watching this update and hanging around to the very end. You can get more details from us in the link below in terms of learning a little bit more about this. We also send out a regular newsletter that'll be coming out to you with further updates from time to time. So thanks for watching, and remember that knowledge is empowering, but only if you act on it.